Welcome back. We have a number of calls in the day to get to today. Ferrari, Robert, downgraded to sell. That's at Alpha Value Beta Europe. The call happened yesterday. Stock brushing it off today. Price target goes to 357 euros from 342. That equates to about 396 from 379 US dollars. You own the stock.
We do, and it's hitting a record high today. It's up 40% year to date. They are the only European automaker to raise guidance this quarter, and it illustrates the value in the ultra luxury segment. It's more resilient to shocks to demand and the incredible brand strength that they have. I mean, I think the one thing that we struggle with is the valuation is 49 times forward PE. That's not typically something that we would be actively interested in. But remember, we bought it a long time ago. It's not even achieved long-term status for us. So we're going to be staying in this company. But this is a business with software-like profitability. 50% gross margins, 22% free cash flow margins, and high single-digit top and bottom line growth. It's a really good business.
Okay. Snowflake, Steph, reports this week, tomorrow, right, after the bell?
Yeah.
Target gets cut to 200 from 236 at Citi, who reiterates its neutral call on the name.
It's been a tough one. I've been wrong, but I still like it. It's down 19% in the past year. The IGV growth index is actually up 25% in the past year. So there's certainly catch up if they can actually execute. Product revenue expectations are for 24% year-over-year growth. The reason the stock hasn't done well is because it's down from the mid-30s. I do think that they can see stabilization in product revenue growth. You're seeing green shoots in their cloud migration projects. And I still think you need data and clean data and a lot of scalable data for AI, and they play in that space. So I'm going to stick with it. It's a small position. My expectations are very low, though.
Rob, Lulu, reiterated overweight, JPM, price target 338, and they've got earnings on 829. That's next week.
This is a falling knife that we actually caught and got cut. Okay.
Rob, they tell you never to catch a falling knife.
Well, we thought it looked pretty attractive, and, and we could get it.
All right.
You know, the valuation today is the cheapest it's been since its COVID lows. And, you know, this is a business that has industry-leading profitability. I would be kidding everybody if I didn't say in a portfolio that's had a lot of successes, this may someday be a tax loss candidate this year. However, it's hard to do that when we think they are going to post a really good quarter coming up.
You want to hit Mastercard, Rob, while I have you? Overweight's the rating, 570, the price target, top pick at JP Morgan. They think they have a better line of sight into their guide.
Yeah, I think there is some risk to the top line if there is continued deterioration in economic activity. I mean, I think you definitely have to pay attention to that. But if we get this soft landing narrative to play out exactly as we want, these companies both trade, and we own Visa as well, both trade in line with their historic long-term averages and have been delivering better than their typical total volume.
A couple calls I want to get you on, Josh, that were earlier this week, but we didn't have a chance to speak to you. Shake Shack and Sweetgreen. Okay, Piper Sandler downgrades those names to neutral from overweight. We know that you just bought Sweetgreen, right? You told our viewers that last time, and you obviously own Shack, as we know.
Yeah, I mean, these are basically calls about stocks that have gone up a lot. Shake Shack is one of the best performers of the summer in the group, but just overall, the total stock market. And Sweetgreen is coming off a pretty big rally as well. And it's possible that a lot of the recent great news is priced in. But I'm looking at both of these as a longer-term opportunity. These are chains with a few hundred stores each that could be in the thousands. And so I think if you're a trader and you have a stock that goes up a lot, maybe you want to take a profit. But if you're an investor, just the mere fact that these stocks have gone up in value doesn't always mean that there's not more to come. And in both of these cases, I think there is more to come. So I understand the downgrades. I just don't think that they apply to what I'm trying to do here.
Give me something quickly on Live Nation, too, which, you know, the DOJ is seeking to break up Ticketmaster, Live Nation. You own the stock. What's your thought here? Again, this happened on Monday, but I want your view today.
So the stock is at a 52-week high basically, and it has not fallen as a result. And I don't think most of the sell-side analysts that are covering this are expecting a full-scale breakup. That's just not what the base case is as far as what the remedy will be. So I don't think that they're at that much risk of that. And if they were, historically, those types of breakups actually lead to a creation of shareholder value. Ticketmaster as a standalone business is a great business. The venues, of course, Live Nation is very dominant there because they do a great job, and the fans like returning to those venues. So if that were to be the worst case scenario, I don't even think it's that bad. The reality is the consumer has demonstrated an insatiable appetite for live entertainment. This continues through this summer, and Live Nation is the best company in the space, and that has not changed, will not change.